Hi, this is Dustin with Dustin's Dollars. Today I'm going to be wrapping up my mini series on AITX, talking through my valuation model and all the assumptions and projections that go into that, why I am not currently looking to buy the stock. Before I get into that, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I may own I do not own any investments in AITX. I was evaluating it. This is sort of the current state of the conclusion of my investigation into AITX. I do own, for full transparency, I do have a long position in a competitor to AITX called Nightscope. But basically everything in this video should be for your entertainment purposes only, because I could be wrong about everything that I say here. And you need to do your own research before making any investment decisions. All right, so let me go through this model that I've put together, and I'm going to talk about some of the assumptions that I have built into it and sort of where I came up with. So roughly the model that I put together here, I tried to ultimately get into sort of a simple discounted cash flow model to value the company. And I looked at a couple of different things, and I've already covered sort of their revenue growth, and I have a model here for incorporating that I think is very optimistic in terms of the revenue growth. I'll go over that in a moment. Then I have a model for what are their sort of, I'm going to call this air quotes, gross profit margins there. And I'll go through that in a second, but this is roughly going to be, in the 30 to 40% range. I have a prior video as to why I'm doing that. And when I say gross profit margins here, this is after, this also does include things that are taken off of that before I'm reporting this gross profit number here, air quotes again, is taking off those sales of future revenue that takes off, a 16% straight off of the revenue. And then from there, I'm sort of computing a gross profit. I estimated this is a horrible way to do it, but I estimated the G&A and their R&D costs for the first projected quarter here as the average of the prior 3 quarters, and then multiplied by my estimated growth in their employee count. And I try to keep this, I think, fairly conservative. And I'll go through the employee count in just a moment. But that was that. That's how I got their G&A and their R&D expenses. I assume that their operating lease stayed flat for this whole period that I projected out. And again, I think that's probably more optimistic than what is realistic, because if they actually grow like crazy, as I sort of have the revenue projections here, I can imagine that they would need some more space, but that is what it is. And then I modeled out their debt payments that they have in their current filings. I sort of modeled out some new debt issuance that I'll go into, and then I also modeled out their dilution over time. I have again, total guesstimates of share price that could happen at, and I'll go through my assumptions there as I walk through this. But then I, did the arithmetic to add and subtract all of those factors out, right? Effectively, the gross profit revenue multiplied by my estimate of their margin, minus their G&A, minus their R&D, minus their operating lease, minus any debt payments that are due, bonds that become to maturity, and then also interest expense that they'll have in that quarter. And then I add in any new debt issuance, subtract off any interest from new debt that I assume they would issue. And then I add in the proceeds from any new dilution, any new shares that they would sell. And that gets me to sort of their ending cash position in the quarter. And I actually am using this, I called it cash plus receivables minus payables. That's really only relevant for the first quarter, but that is where I got to this number here. And if you look at their most recent reported numbers, I took their cash plus their accounts receivable plus their share proceeds receivable, plus I think they had some prepaid expenses, maybe that might be this last term here, and then minus their accounts receivable. I subtracted that off, and so that's where I got this starting number here. And that's why sometimes I actually allow this to go a little bit negative, because they actually do run if you looked in their most recent filing, I think this is it. Is this for November? Yeah, November 30th, 2021. You can see that their accounts payable was actually quite substantial, which would be money that they owe, that they have to pay to somebody else. Accounts payable and accrued expenses, $1.76 million. So that's quite a lot. So I actually did allow this column to run negative sometimes, even though in reality probably they wouldn't have a negative cash on hand. But again, these are fuzzy estimates and fuzzy numbers anyways. They're just projections. So I allowed it to go just a tad bit negative in a couple instances here. Really, that comes out to, I think, a more optimistic projection for the company because that means less dilution. Okay, so that is the overall structure of the model. I'm going to go into some of my assumptions first. And my assumptions here that I baked into the revenue growth were that quarter over quarter in 2021, they would grow 50%. That annualizes out to, a 5x. And I think that is consistent with the statement that is put in the filings that they expect to have 4 to 5x growth in the year, and so that represents that. And then going forward in 2023 and onwards, I said I sort of scaled it back, right? Because I can't imagine that you can't 5x forever. That's ridiculous. But I figured they're going to continue with this high growth path. And so I said in 2023, 40%, 2024, 30%, 2025, 20%, and 2026, 15%, right? And these are quarter over quarter straight line growth, right? So annualized, that's much higher. That's effectively, year over year. That's kind of in 2022, 5x. And then in the years following that, almost a 4x, almost a 3x, a 2x, and then almost a 75% growth. Then I have sort of some more modest growth after that point in 2027 and beyond that I have over in another tab for the actual DCF. But this is my sort of projection until they get positive cash flows. That's what this entire sheet is about in this entire model. For their margins, what I did was I estimated a percent of the revenue that comes from rentals. And I sort of did this as a straight line up in 2022 all the way to 2026. Year over year, I said, 50%, not year over year, just in each year, 50%, 60%, 70%, 75%, and then 80% is where that sort of tops out in 2026. And then I assume that their gross margins for the rentals were somewhere around 42%, and the gross margins for their direct sales were 30%. And again, I will remind you, I noted it earlier, but these gross margins are much lower than what they have in their filings. I have an entire video going over my model of their, what I actually observed in the gross margins when I actually looked at some of their expenses that I don't think are captured. I'm almost positive are not captured in their, cost of goods sold. At least I couldn't see how the numbers matched up, right? And that really includes, depreciation, and so that, and then this also. These numbers are also after the 16.26, I think is what it is, roughly 16% that also gets taken off from the sale of future revenues. So these numbers, if those numbers look low to you as somebody who's familiar with the company, that is why I have another video talking about one video talking about the gross margins, trying to understand that and sort of how I interpret things, and then another video talking about their sale of future revenues. So if you're interested in those, feel free to refer back to my other videos to understand why I'm using these numbers and why this doesn't look like 70% or 80%. Okay, so that is the model that I have built in. Oh, and then let's talk about employee growth real quick. I had to a bit make up these prior numbers. These numbers don't change the model, but in their filings, I think I saw that they said sometime in May of 2021 they had like 51 employees or something. I think that was a number. Don't quote me on that. Somewhere in the low 50s, if I recall correctly. And then they did say that as of the quarter end of November 30th, 2021, they had 71 employees. So what I did was I assumed that they had a very, very modest employee growth. And that is, again, like I said, what I scaled their general administrative and their R&D expenses straight off of that employee number, right? So this is just a ratio. All of these I divide by 71. So 73 over 71 for this quarter, 75 over 71 for that quarter, etc. on down. And I kind of figured that they would end their fiscal year 2022 or 2023, I guess it is, with 80 employees. The next year they would end with 90 employees. The next year they would end with 100 employees. The next year they would end with 110, and then I figured after that they grow maybe a tad faster. It doesn't make a material difference, but it does scale up a bit after that, up to 125 in the following. I guess that's 3 quarters later, right? That they would grow just a bit faster after that point as they grow into a much larger company, according to my projections that I have here. And I actually, if I'm calling out some of these assumptions, which I'll maybe go over in the end, but I think that employee growth and, perhaps then also the GA and R&D expenses are likely underestimated, right? If this company actually grows like crazy, like it have for the revenue projections, which I'll get to in just a moment in more detail, it's hard for me to imagine that their employee count would less than double as their revenue effectively, more than 10x's, right? So that's, but I'm trying to be, maybe I should have stated the model I'm trying to come up with here. I'm trying to come up with a pretty, let's say, full-throated bull case here, right? Where their revenue does grow quite a lot, their expenses grow modestly, and like I said before, I actually assume that their operating lease expense does not increase, that it stays flat, that the quarterly expenses they had in the most recent reported quarter are the same expenses that they have for every quarter report in my projections here. And then going through here, looking at the debt issuance. So they have a lot of debt, that is debt payments that are going to be due in the next couple quarters. I made the assumption that they could effectively roll this over by issuing new debt at 12% interest, that they would issue $10 million in this, the quarter that we are in right now, right? That is ended in May 2022. They would issue another $8 million in the quarter ended August of 2022 at 12%. And so that's what this new debt issuance column is here. Those are the only new debt issuance that I expected, or that I put into my model here. And that kind of keeps their debt load. It increases a bit, but I don't think it's reasonable to assume that they're going to fund everything out of debt, especially not at 12%, right? Because that's just going to stack up and people are going to want to stop lending to them. And so what I also then built in here is dilution, right? And I think that's consistent with what the company has done in the recent past is diluting common stock, the common shares. And I have this column here, average share price, is a total stab in the dark of showing some growth in the share price of the company at the same time that they are doing dilution in this model. Like this is a pretty big assumption on my part, but I assume that the stock price would walk up slowly. And when I say slowly, it's actually not that slowly. This is what, a 20% return per year. And it even jumps even further as things sort of go on. And I would see that some of the stock or the company is really doing well to the point where this is almost more than a 3x from current prices, or roughly a 3x from current prices, I guess, up to 0.05 by the end of February 2025. And this is sort of a glide path up to that valuation, or to that share price, I should say. And I will get to my final valuation in a moment, but I think that's I think that's a fairly bullish glide path to say that the company is, for any company to say, hey, in 3 years it's going to be 3x what the current price is. I mean, if anybody can, really be confident that something's going to be even higher than that, then great. But I had to pick something because it's relevant to the model here, because they are actually diluting, and so I had to have some share price that they would be using for their dilution. Okay, so, and then this is how much shares I expected they sold in every quarter. This one actually, I think, came from what they actually have sold. I think using the numbers in the otcmarkets.com versus the most recent filing. And then the rest of these are my assumptions, or my numbers that I plugged in here to make the cash position roughly work out to where they stay solvent quarter after quarter. So I've already been talking for 13 minutes, so I'm going to go over this as quickly as I can now. So revenue growth, what does it look like? It looks like this, right? They grow quickly, right? They're growing almost exponentially to a degree, right? That new revenue is a multiple of their prior revenue. And according to this model, in 2026, they would end, their fiscal Q3 in 2026 for, I guess, fiscal year 2027 would have them making, $64 million in revenue, which is a massive growth, right? As their most recent quarter. Oh, by the way, I started this out the first quarter here, I should state that explicitly, how I seeded their first quarter, how I got from this number, and this is the average of their prior 4 quarters. The average of the prior 4 quarters times the growth rate that I put in for 2022, which was 50%. So 50% quarter over quarter. So that's how I got the first number here, the starting number. And so that gets me, right, like I said, that gets you to a quarterly revenue number of about $64 million. And I assume that they're, as I said down there, that their profit margins actually increase over time because their percent of rental increases over time. And I think the rentals give them higher profit margins. So that gets you, I'm calling it air quotes, gross profit of almost $25 million, which is, again, much, much larger than the current company is producing. And so in your last quarter here, that gets you, I'm again what I think are very conservative, very, very conservative, or maybe what would you say, optimistic growth in expenses, meaning that they grow quite slowly. And given those assumptions here, that would give you what's this, almost $14 million in cash flow per quarter. So that is roughly what the model looks like and roughly the results of the model here, at least until they get to the point of having positive free cash flow. That's what the revenues look like. This is what their gross profit looks like quarter over quarter. And you can even barely see the bars in these initial quarters because it goes up. And not only, again, does their revenue grow up, but their gross profit margins go up over time. So again, by the end, you're hitting, what's that gross profit? $25 million in gross profit in that last quarter. And this is what their operating expenses and their debt costs look like, right? And a lot of this orange, not the orange, the green bars that you see here, these are their actual debt payments that are due from their most recent filing, assuming that I got these all correct. And this light blue, this big bar you see here, that's where I assume that the new debt that I had modeled as being issued would actually be paid back. And that is when they first finally have the cash to start paying it back. So, but again, you can see that the G&A costs here, I started out as an average of the most recent 3 quarters scaled by my assumption in the employee growth. And you can see that that's actually, I think, fairly conservative because their most recent reported G&A numbers were, but 3.9 million. In this model, I'm actually assuming they don't get back to that level of G&A expenses in a quarter until 2025. And same for the R&D expenses. So again, I think that's fairly optimistic to assume that they would not have the same level of expenses for another 3 years. You can make your own conclusion based off of that. But I put all of this together to try to paint this in a fairly positive picture. And if I take the results of this model and I go over into my simple discounted cash flow model, so for this, I'm using a discount rate of 20% because I think that's, this is a very, very risky stock. I think 20% is appropriate, maybe even low for something that's at this level of risk, but that's what I'm using for this model. So based on the prior projections, right, that model, I get effectively 0 free cash flow all the way through to 2025. And then in 2026, there was finally $21 million of free cash flow. In 2027, there is about $55 million in free cash flow. And then I assume that this would grow by 20% in 2028 and 2029, 15% into 2030. And then after that, to compute their terminal value, assume they'd have a perpetual growth rate of 10%. And so when you put that against the discount rate of 20%, that gives you terminal value of $910 million. And then this row right here, row number 5 in my spreadsheet, is the discounted cash flow of all of these rows, all these cash flows that I'm expecting them to get in 2026 through 2030. So when you add those all up, that gets me a sum of the discounted cash flows of almost exactly $1 billion, $1.008 billion. And that's where it came out. I wasn't really, this is where it came out with the first time I built this model. I wasn't trying to fit any particular numbers anywhere. I just try to make reasonable assumptions, actually optimistic assumptions along the way. So if I do that, it was a $1 billion, sort of valuation for the company. Now I look at what is the percent of cash flows that are sort of attributable to common shares. And I did this by dividing the, this came from I have a prior video talking about the share classes and how I think the conversion of the, I pulled these numbers on my prior spreadsheet, just my prior presentation, just get the math right. But effectively, this is 14.3% because of this Series F shares, and because as you convert those, they create more and more common shares, and dilutes it, a ridiculous amount. And in the end, as with the current number of outstanding shares, it would come to about, after all the conversions, like 33.1 billion shares. And so this just is that representation that, hey, the common shares is actually a small minority of the overall claims of the cash flow of the company. Assuming that like a dividend were to be paid out, which would incentivize every single one of those Series F holders to convert into common shares in order to receive that dividend. Because right now, if I recall correctly, Series F shares do not receive dividends. So that is why I'm only counting the common shares as 14.3% of the, of the claim on the cash flows. So 14.3% of that, roughly $1 billion comes out to, $144 million. And so as of the most recent filing, this is how many common shares there were outstanding. In my model, they would dilute by this many shares, which gets you, not quite double the amount of shares outstanding, but it gets you to, what is it, 823, or no, is it 8 point, I can't get it. Is there a way to format this with commas? Let's see. Just have to do it manually. Oh yeah, I guess I know the numbers, the order of magnitude here. So it gets you to about 8.2 billion outstanding common shares. And again, this is assuming that none of the Series F shares are converted, et cetera, et cetera. This is just from the dilution that would need to be done in order to fund the company over this time period that I modeled. That gets me, this is the conclusion of everything, to a net present value per common share of about 1.75 cents. And that's, a stone's throw away from the current trading price. And so what that tells me is, at least based on these, what I think are fairly optimistic assumptions to model out the company over many years, that there's no real margin of safety at this current price, right? Everything needs to go right in order for this to even be fairly priced. And there's a lot of things that could go wrong, right? I think it's, hopefully even people who are bullish on the stock could say, well, I'm not sure they're going to get to the point where they're making $64 million of revenue per quarter in a mere 4 years. I mean, that's 4.5 years, I guess. I'm not saying they can't. Again, that's my model. I think it's possible, at least if you're drinking the Kool-Aid and you're saying, hey, we think we're going to 5x, and if you think they're going to continue fairly high growth rate for years to come, it's possible. Other companies have certainly done it, and they could do it too. Just that a lot of things need to go right for that to happen. And so I think at the current price, there's just not a lot of margin of safety built in, and there's not as much upside in there as I think some people might expect, right? I don't have any real fundamental basis for why this is going to hit like $1 per share for the common stock, right? That's I just don't see that happening. And yeah, so a couple other takeaways here that I would say are, I think just thinking of what could change my mind, what could change my model here that would then change my mind is really what I should say. But I think getting rid of the Series F shares or doing something to change that would go a long way, right? That dilution, because of the fact that we're still only counting the common shares as 14.3% of the of a claim to the discounted cash flows, really limits the upside. And to the point where I guess what I'm saying is the numbers, the revenue and the free cash flow need to be really, really big in order for that to really trickle down to the common shares. I think another one is that, if you have a bull case, or if you're a mega bull in this company, you really think they're going to make a ton of money in the future, you really have to feel the pain of those sales of future revenue agreements that they have, where some investors are getting to take 16% of their cash of their revenue. I shouldn't say of the cash, of their revenue as it comes in, just straight off the top. That also really, really hurts the margins to the point where I think if those margins were 16 points higher, that would be 16 absolute points higher. That could materially change the valuation like quite a bit. Again, assuming that everything goes very well for the company and they do grow like crazy, and hopefully that's pretty clear to anybody who's thought it through. But okay, so that is my conclusion today. That is why, after doing all of my due diligence, I am not looking to buy AITX stock. Again, not investment advice. You need to do your own research to come to your own conclusions. But these are my numbers. This is how I came to my conclusion. So that's what I wanted to cover. Thank you very much.